Unrealistic expectations will make your path to profitability much more difficult than it needs to be. In this video, I'm going to help you set realistic expectations of what it's going to take to become a consistently profitable day trader. I want to start by saying there are zero shortcuts to becoming a successful trader. It takes a very serious commitment. Unfortunately, the internet is littered with advertising and misinformation that will tell you otherwise. It's my mission to place you on a path where your success will be determined by your commitment, not your knowledge. Becoming consistently profitable requires two things. Number one, a repeatable trading strategy. And number two, an objective mindset to execute that edge flawlessly. Most of the new traders I work with will come to me with incomplete trading strategies. Let's consider a very basic example. Suppose you're trading a strategy where one context requirement is that price is forming a double top or a double bottom, meaning it's retesting a prior high or low and being rejected. Here we have a textbook definition of a double bottom. However, what about this example? Is this a double bottom? How about this one? Is this a double bottom? Poor definitions will lead to uncertainty, which in turn leads to poor execution. Later in the course, I will be walking you through step by step how to build a proper playbook, which will include things like the logic behind your strategies, the context and triggers that you use, trade management, risk management, pre-trade R analysis, and more. A well-defined playbook should never leave you second guessing. Yet simply having a well-defined edge isn't enough. To become consistently profitable, you also need an objective mindset to consistently execute your edge without any bias. The tool we use to extract money from the market is our trading strategy. The strategy is nothing more than an edge that signals when there's a higher probability of one thing happening over another. The outcome of a given trade can only be one of three things: a win, a loss, or break even. There is a probability tied to each one of those outcomes. Over a long enough series of trades, all those outcomes will be realized, assuming your execution is flawless. Yet most traders struggle to internalize this concept. Although we believe that our perceptions provide us with an objective view of the world, the truth is our evolutionary history did not equip us to perceive the world as it is, a chaotic place where every single outcome is purely based on luck. Our brains evolved to prioritize survival, to create order and certainty out of chaos. Our brains do this by minimizing uncertainty. Imagine thousands of years ago, one of our ancient ancestors heard a rustling in a bush or in the grass. Sure, it could be due to the wind, but after seeing a family member eaten by a lion a week ago, they wouldn't sit around to observe or contemplate the odds of it really being a lion. It was much safer to just assume the rustling was a lion and run. Finding simple patterns and shortcuts like this is how we've evolved and survived. They help us navigate the world, but they also make us bad at thinking objectively. I think we all recognize the existence of chance or luck, but we fight the idea that despite our best efforts, things just don't always work out the way that we want, such as an individual trade. As a result, we tend to label our decision making as good or bad based on a small set of outcomes. When a trade ends in a good outcome, the novice will attribute it to their skills. When something bad happens, they attribute it to a bad trading strategy or blame the market. In reality, if you're executing your strategy properly, the outcome of a single trade is nothing more than chance. Yet simply being aware of this irrational behavior and simply wanting to change typically isn't enough. This is where most online education, I believe, is failing traders. They say you need discipline. Using the white knuckle approach, I promise you, isn't enough. Making better decisions starts with becoming comfortable with not knowing. Since childhood, we've been discouraged from saying I don't know or I'm not sure. Yet I'm not sure is a more accurate representation of the world. The world is a random place. The influence of luck makes it impossible to predict exactly how things will ever turn out. When analyzing our trades on an individual basis or in a small group, the outcomes are entirely based on luck. Once you internalize this, you'll be able to execute your plan because you won't be putting any statistical relevance on the very next trade. So how do you internalize this concept and put yourself into a place to trade objectively? I personally believe new traders struggle with this for a few reasons. First, you must understand the logic behind your strategies. Why will they work? What is the logic behind the tools and the indicators you use to analyze the markets? If you don't understand the logic or theory, at some point you're going to begin to question the strategy, which will likely lead to poor execution. The next step to building an objective mindset is to develop some basic strategy development skills. You need a thorough understanding of important concepts like R analysis, expectancy, risk management, and much more. You'll begin to learn how to manipulate a strategy to better suit your goals and who you are as a day trader. Third, you should be backtesting your strategies as you begin to develop your playbooks. This is where you begin to learn to recognize the context and triggers you use in your strategies. You'll begin to find questions that need answering, such as the double bottom or top example from earlier. Backtesting will also help you cement the belief that any single trade is nothing more than a bet, as you see the randomness unfold in your testing. Once you have a rough draft of your playbook, it's time to start trading on a simulated account. This is the most critical step in developing objectivity for a new day trader. I'm still shocked at the number of day traders that have never sim traded, yet they wonder why they're struggling. I began my career in an elite trading firm. You know what I did for the first few months? I traded on sim. The firm was never going to give me capital until I proved I could at least make money on a sim account. Remember, I was learning from some of the best day traders in the world. If I did it in a professional environment with tons of support, you better make sure you sim trade while you're trying to do this on your own. How long should you trade on sim? Until you've proven that you can execute your edge with very few mistakes. If I was training you personally one-on-one, I would want to see 30 days of consistent profitability before letting you attempt to go live. I promise you, if you can't make money on a simulated account, you will never do it in a live market. So don't blow your hard-earned money before you even know what you're doing. It doesn't matter how much capital you have to trade or if you can afford to lose some money. This is the only time you can experience trading free of emotions caused by money being on the line. It's going to set a baseline for you mentally of what it's like to trade free of any emotions. Most traders go right to a live account and mess up the psychological side of the game before they even know what they're doing. They just become another statistic. Most charting software today on the market have a replay mode, so you have absolutely no excuse to not get in the sim time. Promise me right now that you're going to trade on a simulated account until you've proven you can consistently make money. If you're currently trading live and losing money, stop and get on a sim account. Once you begin sim trading, it's imperative that you start tracking your trades and reviewing your analytics. You can't improve what you don't measure. Tracking your trades will help you build better definitions, allowing you to trade with more objectivity. Finally, once you do go live, it's imperative to start by trading the minimum share or contract size possible. You're going to make some bad decisions and mistakes as a new trader. Trading small and slowly upping your position size as you progress will lead to less pressure, resulting in less mental mistakes. Your trading focus must remain on execution. It can never be about the money. If you're trading with too much size, it will always be about the money. Be patient. In time, it will come. And when it does, you can typically ramp up things really quickly. This course is going to walk you through all of it. If you want to exponentially increase your odds of success, please don't skip any of these steps. Don't forget to subscribe, and I'll see you in the next video. Take care.